Something is happening in the silver market right now that most of the people covering it every day are getting completely backwards. It's not because the numbers are hidden, they're public. It's because everyone is watching the wrong clock. Silver has pulled back hard over the past several weeks. If you're holding it, the red on your screen is real, and the frustration is real. The easy explanation everywhere you look is simple. The Federal Reserve is staying hawkish, rates are staying higher for longer, and non-yielding metals like silver just can't compete with a treasury bond paying you real interest. That explanation isn't wrong, it's just incomplete. Here's what it leaves out. While traders are reacting to this week's Fed language, a much slower, much quieter story has been building underneath the price chart for 6 straight years. Global silver demand has now outstripped mine supply for 6 consecutive years in a row. Not one bad year, not a temporary imbalance. 6 years, back to back, where the world used more silver than it dug out of the ground. Think about what that actually means. Every single year, the buffer of above-ground silver, the stockpiles built up over decades, gets a little thinner. And unlike a stock split or a bond issuance, you cannot manufacture new silver overnight just because demand picked up. Mines take years to permit, build, and bring online. That deficit doesn't close because of a press conference. Now layer in what's happening on the demand side, because this is where silver's story genuinely diverges from every other commodity. About 60% of all silver used every year goes into electronics, solar panels, and semiconductors. Not jewelry, not coins, but industrial applications with no real substitute. Silver is the most electrically conductive metal on the periodic table. That's not a market opinion. That's physics. Solar manufacturing alone has more than doubled its silver consumption over the past decade, driven by government-mandated installation targets across the US, Europe, and China. Electric vehicles use meaningfully more silver per unit than traditional cars in charging systems and electronics. Add data center buildouts, AI infrastructure, 5G expansion, and advanced electronics. Every one of these sectors is growing, and none of them can substitute silver out of their designs. Here's the part almost nobody connects. These industrial buyers don't pause their purchasing because the Fed hiked rates. A solar panel manufacturer with a government contract doesn't care what happened at the last FOMC meeting. Their demand is structural, not sentimental. Now for the piece that makes this moment genuinely different from past cycles. For roughly 70 years, central banks followed an unwritten rule. Buy gold, ignore silver completely. Gold was the reserve asset. Silver was just industrial. That rule held through every decade, every crisis, every regime change, until recently. Multiple institutional research desks have started actively discussing silver alongside gold as a diversification asset, precisely because it offers something gold doesn't. Real, growing industrial demand layered on top of monetary scarcity. If even a small fraction of the money that has flowed into gold over the past few years started looking seriously at silver, the math gets extreme fast. The entire global silver market, in dollar terms, is a small fraction of the gold market. When meaningful capital moves into a market this size, prices don't drift, they gap. History already gave us a preview of this physics. In 1979, 2 private investors, not a government, not an institution, began accumulating a significant share of the world's available physical silver. The price moved from roughly $6 an ounce to nearly $50 in about 14 months. That was 2 individuals working with finite capital in a market far larger relative to their resources than today's silver market is relative to global institutional capital. Now look at the gold-silver ratio, one of the oldest tools in this market. Historically, it averages somewhere in the mid-60s to 70-1. When it climbs well above that, sometimes past 80 or even higher during panic periods, it's historically flagged silver as significantly undervalued relative to gold. When it compresses back down, it has tended to do so with silver outperforming, not gold falling. Let's be honest about the other side of this, because a real analysis doesn't ignore it. If the Fed holds a genuinely hawkish path through the rest of this year, and Treasury yields stay elevated, the opportunity cost of holding non-yielding metals stays real. A strong jobs report or sticky inflation print can absolutely trigger another leg lower in the short term. That risk is not hypothetical, and anyone telling you silver only goes up from here isn't giving you the full picture. But here's the tension that the short-term headlines can't resolve. A hawkish Fed fighting inflation by raising rates also makes the government's own debt more expensive to service. That's a slow-moving structural pressure that doesn't disappear just because this quarter's price action looks bearish. So here's your framework for watching this going forward, not a prediction with a specific date attached. Watch the gold-silver ratio. A meaningful compression while headline prices are still soft is historically an early signal. Watch COMEX registered silver inventories, which have been trending lower for months. That's the physical buffer shrinking in real time. And watch industrial demand data out of the solar and EV sectors, because that demand doesn't move on Fed announcements. The price today is telling you one story. The structure underneath it may be telling you something else entirely. History suggests that eventually the structure wins, not immediately and not without volatility along the way. This video is for education and discussion only, not financial advice. Do your own research and make decisions based on your own risk tolerance and time horizon. If this breakdown was useful, let me know in the comments where you're watching from, and tell me, do you think the price or the structure is right this time?